Stock Talks is brought to you by StockExec.com, the only online platform in the world with an annual average return of 36.93%. Your hosts for today, CEO Heather Ramsey and founder Sydney Tremayne, discussing cutting-edge, behind-the-scenes information, showing you how you can optimize your stock investments and increase your returns.
Hello and welcome to StockExec's series of Stock Talks. In fact, Stock Talk number 3, where we're going to look at and compare what many people are involved in mutual funds in relation to the StockExec system. Not necessarily either or, it could be a yes and, but we want you to be educated as to what the world of mutual funds means to you, both from a return and from a cost standpoint. And without further ado, I want to make sure that our founder, Sydney Tremayne of StockExec, is with us here on the line. Sydney, are you there?
I'm right here, bright-eyed and bushy-tailed.
Well, wonderful, and welcome to all who are watching and listening, whether live or from the recording. Our commitment is to both first bring you extraordinary returns with a very easy system. Second, to continually be transparent to how it all works. And third, to continually educate you in the world of investing. And so we have done our best to think of the questions you would be asking us as a prospect. You may be a client already in the StockExec family of investors, fantastic. And yet many of you, whether you're on board with us yet or not, are in the world of or have considered being in the world of mutual funds as one of your investment options. And so we could have made this title less provocative and just called it How Mutual Funds Compare to StockExec, a very neutral, benign title. We added a touch of provocativeness in the why mutual funds may be costing you, because we really wanted to bring attention to you and educate you as to what are the known and hidden costs within mutual funds. After this, you may choose to still remain in mutual funds, which is fine with us, and add on the StockExec to your portfolio. It's really up to you. Our commitment is to ensure that you're informed and educated and making educated decisions. So any additions you want to add to the intro of this theme before we jump right in, Sydney?
No, other than mutual funds serve a purpose for some people, not for everybody. But our program isn't for everybody either.
So the more you understand both, the more you can make the right fit choices. Whether, again, with mutual funds, and by no means whether you have a broker as well, I want to say, and or you may be a financial broker listening and watching. We have nothing against you having one or being one either. It's a matter of educating.
I hope you don't. I used to be one.
Well, indeed, and I have a great one. Fantastic. All right, Sydney, so let's jump in and look at how do mutual fund returns. We're going to look at the comparison in a few different ways, but the returns compared to StockExec return on investment, or ROI.
Very badly. I'm remembering a couple of years ago a young lady who had $100,000 in equity funds, and she was complaining she was making 2%. That was, even in these days, hardly enough to keep up with inflation. And if she was taxed on any of the profits, she was running behind in purchasing power. That was one. I mean, I've heard many, many, many times of people who are complaining about the poor returns they've had for mutual funds. And the reason they do is fairly simple, but we'll touch on that a little later.
Beautiful. So let's jump in to give some quantitative picture to that statement, because that's a fairly big statement, very bad comparison. So let's take a look quantitatively and objectively. And let me just kick off by saying these are not the worst performing mutual funds. They're not the middle of the pack performing mutual funds. These are the top 2, 4, 6, 8 performing mutual funds in the U.S. Correct, Sydney?
Yes, exactly. Of the large caps, the large companies, yes.
Right, which is a sort of the closest direct comparison to what we're holding in the StockExec system.
Well, we cover the whole gamut, but these are the larger ones, the ones you'd find in the Dow Jones Industrial Index, for example.
Terrific. And as I can see, top right, date June 30th, 2016. So at least as of this recording, we are within 30 days of present time data. So analyze this data for us. How does this speak to you? What does this tell you?
It tells me that their returns aren't very good. That's what it tells me. Now, however, the best one, the top one, the top few, as a matter of fact, are better than the average for the S&P 500, Standard & Poor's 500 index. About the top 3, maybe 4, are better than the index for that same 20 years. So that's, for a mutual fund, that's good performance. Now, the figure that you see there is what the client gets. It's not what the real figure is. The fund managers had better be doing, all of them had better be doing better than the index, or certainly better than their peers if they want to hold their jobs. But there are so many charges and fees and so on, and we'll get into those later too. And that knocks the return down to the client.
So this is gross as opposed to net. Before we get into looking at the costs
Now that's net to the client.
This is net to the client.
Yes.
Having said that, what we're looking at, for instance, in the 1 year, we're looking at a number of them actually negative returns.
Yes.
More than half of not just the average or the lowest, but the top mutual funds. I'm also looking at a number of single-digit returns in year 3, year 5, and almost entirely in year 10, only single-digit returns.
Well, one of the things that you have to watch out for if you're following top funds is that they're not going to stay top. They mix, they go up and down, all of them. And very few of them stay at or near the top. And it's the same with stocks. I mean, same sort of thing happens. So you might pick a mutual fund today that is the best in its class, and 2 years from now it's terrible, it's the bottom. There's no way of really forecasting ahead just from the numbers of what a mutual fund is going to do.
That's very interesting, because I just got a new picture of mutual funds compared to the StockExec system. It's not just comparing mutual funds to stocks, we're comparing mutual funds to a stock system. And so wouldn't it be amazing if people have a desire to be in or stay in mutual funds, that at least they'd have a system that would, buy them low and sell them high. But typically people buy mutual funds and pretty much hold on to them, thinking of long-term growth and hope, and cross their fingers that they've bought the best one.
Usually, very, very often, a mutual fund investor doesn't really make the choice. A lot of them are bought through company pension plans, where there's a specific company, a specific set of funds that you can put your money into, and you invest and forget about it. It's one of the attractions of mutual funds is that you can put money in, forget about it, and you hope to get enough money out at the other end to look after your needs. But at 2% or very low rates of return, that's a difficult proposition. I see the purpose of mutual funds as being, apart from company pension plans that you can't escape from, is that they are for people with very little money who want to build up enough money to be able to do something much better with it in terms of investing later. That's what I see as the benefit of mutual funds.
Whereas typically, so that could be an optimal use of it, small amount of capital, starting off better in mutual funds than GICs, and yet,
yes,
and yet predominantly people, I don't say this derogatorily, but in a way kind of fall asleep at the wheel of their own investments over the years, because they get complacent to the 6 or 8% on average, they may get across their mutual funds over their lifetime, forgetting that they ideally are an entry level to grow some wealth at 6 or 8% and then find something that returns, such as they're going to see with ours, in the 30%, as opposed to leaving it 6 and 8% for life in mutual funds.
As I remember it, the average in the States a couple of years ago, the average investment was 120,000, split among 3 funds or 3 companies.
So the average person might have 40 grand in 3 different mutual funds, you're saying?
Yes, yes.
Mm-hmm. And who knows whether they're top, middle, or bottom of the pack, and whether they bought them at the optimal low and or are selling them at the optimal high. Unlikely of all of those variables.
Yes.
Got it.
Funds usually are started and added to from time to time. Sometimes they're added to monthly, which isn't a bad idea.
Mm-hmm.
And you can do that with funds, which you cannot do as easily with stocks. There is a way we could do it with our system, but it's not as easy.
Yeah.
And at $120,000 in mutual funds, people have sort of invested in, as you say, forgotten them. Not necessarily forgotten, but just relaxed and let the fund do its thing. One of the attractions of a fund, seemingly, is that they have managers. There's a fund manager behind, or maybe several fund managers behind each mutual fund. Mm-hmm. And that's a comforting thought to many people.
Yeah, it's true, because when I've discussed, this mutual fund versus that mutual fund with my broker, he'll often not just refer to the performance 1, 3, 5, 10, et cetera, year of the mutual fund, but he will accolade or not the fund manager, who they have met, who they've seen at, brokerage conferences, et cetera. So both they seem to have more peace of mind, i.e. the brokers in the fund managers, and then they pass that on to us as investors in mutual funds. But I sense you're alluding to that may be not dollars in our pockets comfort, but only a sense of comfort.
Yeah, I think that's true.
Righto. So just on this, I would love to have another visual, actually, and maybe perhaps in future we'll add it. This visual is, and we're going to show you the StockExec return on investment if you haven't seen it yet in the next slide. Visually, we're comparing only one thing, ROI, but if you can add, as a viewer or a listener, a second picture in your mind, which is not only the ROI of mutual funds, but the actual wisdom or not of picking the funds compared to our system's wisdom of picking stocks, and the wisdom or not in the timing of when you might buy a mutual fund just because you have cash, and you may be buying a mutual fund at too expensive a price, and you may sell it at too little of a price back to yourself when you do sell it. And so conversely, we've got optimal buying at the low end of stocks and optimal timing of the selling at the high end. So if you can add that visual into your mind, work on your imaginary skills on that visual. That was the second visual that we were discussing just now. So I wanted to give you that summary. Beautiful. So without further ado, if you haven't seen our Stock Talk number 2, we went intentionally and transparently in depth as to this number right here, this 36.94%, the overall annual average return back tested over 41 years of the StockExec system. And so go get that recording and watch or listen to that if you haven't or been with us live, because that is key in terms of our transparency of going into depth as to what our annual average is, how we've calculated it, and what our range has been over the 41 years. In recap, there were only 4 lost years, and 3 of those were only in single-digit losses, and 37 of them are all in positive wins. So that's just a quick recap of that Stock Talk, but go get it if you haven't
Of
watched
those three, the top, those three, the top one of the three was in the 4% range.
it. Exactly. So anything else you want to add to the comparison of the ROI between mutual funds and StockExec system? We're basically looking at over 300% or 3 times the difference compared to the not bottom or middle, but top large cap mutual funds.
No, the number speaks for itself. Now, the next question that somebody's going to have when they see that number is, gee, well, what is the risk?
Mm-hmm. Yeah, and in fact, I think you phrased it in different ways. This was one of your statements that we put up here. I don't know if you wanted to respond to that one, but queued it up for you if you did.
Well, okay, I'll talk about the risk. Personally, I don't see with where we recommend a portfolio, not individual stocks. Individual stocks, I don't care how good the company is, are risky because all stocks go up and down. And when you have one, you're exposed, you have no safety net for that. When you have several stocks, while one is going down, the others are going up, or something close to that. And so having a portfolio is essential in our view. And when I'm talking portfolio, I mean 10 or 12 stocks, each one in a different industry, so you've got diversification across the economy. But if you go back to the other slide, Heather.
In terms of our ROI or the mutual fund ROI?
No, the ROI, the one you had just before this.
Sure.
One of the things I wanted to point out was, and it needs to be remembered, there is nothing that is perfect. There can be nothing that's perfect relative to stocks. It doesn't mean to say they're a gamble, because the way we do them, I don't see the gamble over time. If you look at the top 2 lines, you have the percentage of the second and third line shows you in brackets the percentage of winnings and losses.
Mm-hmm.
And you'll see that the winning positions are slightly below the number of losses, and yet we still make 36 and change percent. And if you go down to the bottom 2 lines, you'll see why. The losses are when the average loss is roughly half the size of the average gain. So we make the profit in 2 ways, not only making the money, but protecting the capital in the first place so we don't lose too much on it. We cut the losses short, is what I'm trying to say. In the open trades, we're a little bit happier because we've got 80% wins, 4 out of 5 winning positions. But we still have smaller losses than we have gains. Does all that make sense? Or did I just confuse everybody with figures?
No, I think I'm with you, and I think they're with you. Basically, what we're saying is that we've got net 36.94%. Just to give another taste from Stock Talk number 2, the ROI, when I came on board and met you, well, your earliest baby version of this was 22%. When I met you a year ago, it was 28%. A fall of 2015, we cracked 30. Winter of 2016, we cracked 32. And now we cracked 36%. And it's important to...
And we're going to be cracking something higher in the future, because I am forever working on this system to improve the results for our clients. And I'm already working on version 3, and I know already, even before any of the programming is done, that is most probably going to give us several percentage points increase.
And as I'm registering in the 12 months that I've known you, or a little more now, we've actually increased our average return within the system, the average potential return for every one of our clients by over 8% from 20 to almost 37. So I'll say conservatively 8%, which just our increase, not our ROI of 36, but just our increase of ROI in just 12 months is higher than the average of all individual investors in stocks, which is 4 to 6% if they're not actually losing. And it's in the ballpark of the total, of the average 6 to 8% in mutual funds. So just our delta in 12 months is beating out most people's average.
And that increase, in fact, is about 1/3. So if they were making $10 profit before, now they're making 15.
Exactly. So without further ado, again, please watch Stock Talk number 2 if you haven't got the in-depth take on the ROI and the range, et cetera, and how we calculate it. Without further ado, one of your other more provocative statements or questions: what does the average investor not know about mutual funds that may be costing them a fortune? So let's get to the cost side. Now that we spent some time on the ROI comparison and the lack of picking or timing of the purchase and the sell, now let's get into, I guess, a fourth category in terms of comparing the cost.
You heard me chuckle. It's not because I'm amused. I'm disappointed with the industry. The industry, by law, has to tell you all of the expenses that come off your return, by law. And they do, in their annual report, in the small print at the very back of the book. There may be 60 or 80 or 100 pages in an annual report for a mutual fund, and there's a whole raft of little stuff in little print at the back that nobody reads. I would like to see these few phrases go on the front cover. What the average, or at least I don't know if it's the average, but many of the salespeople do not tell you about is the additional fees that you're paying, excluding the sales commission up front. You know about that. You pay 5% one way or the other, or they defer the 5% if you buy a rear-end load fund, as they call them, or you pay the 5% up front, or some figure very close to that. You know that. They can't avoid telling you that much. But you don't know about all of the other fees. There are fees for just about everything. You see the full-page ads at pension time, IRA time in the States and RRSP time in Canada, full-page newspaper ads. You pay for those. You pay for the pencils and the paper clips and the office building and the staff and the people that give prizes to leading representatives and brokers. There's a lot of money spent by mutual funds, and you are paying for that with extra fees that are supposed not to be hidden, but in reality they often are. And that makes a difference to what you earn. I think
Wow, you're painting yet another picture in my mind, which I never quite registered. I picture our lean international team of about a dozen people now and growing, compared to the hundreds, if not thousands of people that are, building the funds, managing the funds, selling and marketing the funds to the brokerage companies, all their staff, all their operations, and then them actually dealing with us and educating the infrastructure to get this product called a mutual fund, or many of the mainstream financial products, to us is massive. And as you say, that cost of the infrastructure of hundreds, if not thousands of people getting products to us are embedded in the cost of that product.
And you expect that in any business. It's got to cover its cost and make a profit. You just usually know how they do that. You usually know all of the details. And you do, if you look, you know where to look. You do with mutual funds, but you have to know where to look first.
Shall we drill down perhaps and look at the
Sure, let's do
background
that.
of it?
Let's do
Okay.
that.
Let's take a look at some actual numbers. Now that we painted the picture of this sort of fourth category of comparison, we've compared ROI, we've compared the lack of picking and the lack of timing in the mutual fund typical world purchases. Now we're looking at costs. We gave you the headlines of that. Now let's drill down and look at some actual numbers. So unbundle the magic here for us, Sydney. What are we looking at?
So we're looking at a $10,000 investment,
Okay.
just as an example, with a rear-end load fund, meaning that, and that load is 5% with this example.
Right.
And what that means is if you hang on for 5 years or 7 years or however many the particular fund company wishes, you have a free ride, apparently. Apparently you have a free ride. If you get out in the first year, you're going to be penalized because you pay all of that 5% right in that first year as you get out. And so you're tempted not to get out. You're tempted to stay in, regardless of what the rate of return is. You're sort of concentrating on that fee. And that is the purpose of the fee, so that you stay in. They don't want people leaving. It's a problem when you've got to account for your cash as it leaves. So that in 1 year, your total fees on a profit of $1,000 are 70%. You get to keep a little under $300 out of 1,000. So I've assumed that the fund is going to make 10%, which is, as you saw, relatively high these days. So out of the $1,000 that you theoretically make, you get to keep just under $300. The company gets to keep just over $700.
So let me ask the uneducated, less educated investor questions, just in case it's in the mind of any of our viewers right now, which is, the 5 and 20 years seem to be fairly close. They're in the 30%. If I had just been, less educated, making, guesstimating what the 1 year would be, I would think it was, 30% of profits plus the 5% that I had to pay to get out, and making it about 35%. How is it that it turns out to be 70% in the first year?
Well, your fees on $10,000 would have been, let me see, $500. And the balance of that, of course, you're being charged $702 on the 1,000 profit. So you've got really $202 fees and $500 of rear-end load fee. Does that make sense?
I'm hearing the numbers. I'm still have a bit of my jaw dropped.
Well, you committed to stay with the fund, and if you didn't stay with the fund, and you have a declining amount of penalty as you get out, or cost as you get out, you pay the fee on the way out. And after 1 year, the fee is still 5%. It's still the full fee. So you're going to pay whatever that 5% is on 10,000. That's $500. And your fee in terms of everything else, the other costs that the fund company has, what I look at for most people as the hidden fee is a further $202. So that makes you $702. And that makes you 70% of the $1,000 profit.
Which drops only in year 5, you're saying?
Well, year 5, often the rear-end load is satisfied and it doesn't cost you anything. 5 or 7 years, it's fairly typical.
But even in best case scenario, if people are looking at 30% fees on their returns,
Yes.
As opposed to we think, a 5% fee.
Yep.
That is the big, important, eye-opening news.
And most people don't know about those fees because the representative or the salesperson conveniently forgets to tell you. And nobody can prove that they did or didn't.
Got it. So before we look at comparing the back end load to front end load, is there anything else you wanted to bring people's attention to?
No, the next one that we'll see in a moment shows you or demonstrates to you that the fund company likes you to stay with them, which is why they have a rear end load instead of a front end load. And if you pay the front end load and you go to the next slide, you'll see.
Comparing the 20-year,
If you go to the next slide now, Heather, you'll see you pay more on the 20 years than you did on the rear end load by putting your money in up for paying the fee up front. I know that sounds ridiculous, but that's the way it is. You get charged more for giving the company your money up front, which should be a benefit to the company, than if you have a rear end load and stay with the firm for the same amount of time.
So they're really penalizing you for saying you might get out early because they want your cash more than they actually want the in and out fees. So they'll charge you even more on the front end.
Just think of what it takes when somebody quits the fund or for whatever reason, or wants some of their money out for whatever reason at all. There are, now it's a little bit easier than this, but essentially they have to sell fractions of all of the shares in that they were invested at that time to let you have your money, because your money is in stock. Now, in reality, they keep a bit of a reserve in cash, which is another reason that that affects your rate of return in a mutual fund. Whatever is kept in cash doesn't earn very much.
Right. Wow. Okay, got it. So without further ado, we'll maybe look at just a final couple of ways to compare. We've looked at the ROI comparison of the top mutual funds, the lack usually of actual picking, and definitely usually the lack of ideal timing of the buy and the sell. Now looking at the costs, how about from a risk standpoint? Are there any additional ways you compare the risk of investing, the same amount of capital in mutual funds versus in StockExec system?
The advantage of each is that we want people to be diversified and not have single stocks. Single stocks are dangerous. I mentioned that earlier. But a collection of them have less danger. Something goes wrong with one company and the others will hold it up in terms of their profit.
Right.
So there's a similarity between the two. Mutual funds will have more stocks in them than we think most investors in StockExec will have. But still, the point is still there. The diversification and a collection of stocks reduces risk.
Right. So in a way, people have a custom mini mutual fund of usually 10 to 12 stocks in their StockExec portfolio. The difference is that every single stock has been hand-picked, so to speak, by the system for both picked as well as time for its buy, for its hold, and for its sell within that, in a sense, custom, mutual fund.
It's the timing that is the advantage.
Yeah. Got it. Okay. Great. And how about, I guess this is a drill down of the same kind of risk comparison question, which is, aren't a group of stocks, like a larger group of stocks, we're not really saying that StockExec isn't considering, as you said, investing or advising anybody to invest in a single stock. But let's just say a mutual fund. Do you have any sense of the average number of stocks in a mutual fund?
They vary. It depends. They vary quite good. But you could see 100 in a mutual fund quite easily.
That was the number I was going to sort of compare it to. So let's say, is there much of a difference in risk or return in a cluster of 100 stocks versus a cluster that we're recommending of 10 or more stocks within somebody's StockExec portfolio?
Not really. The trick is the timing. And mutual funds managers typically don't do timing very well. They buy something and hang on to it, But part of our system is based on timing, and it's fairly accurate, and that's why we get bigger returns.
Right. So regardless of the number of stocks, we are diversified across 10 to 12 sectors, each client, and 100% of the stocks are receiving the optimal timing on the buy, hold, and sell.
Exactly.
Got it. Okay, great. And how about, are there different, maybe sort of as a final main theme, are there different types of investors, sort of a character of investor that you would describe that's more suited to mutual funds versus the StockExec system?
Yes, and it's pretty obvious that I'm not a fan of mutual funds, but there are times that mutual funds are the best choice. And what I'm thinking of particularly is young folks just starting out with very little money who want to build their money up before maybe they do something else. It's easier to do what's known as dollar cost averaging with mutual funds. And what I mean by that is some people will invest, let's say, $25 or $50 every month. And if the stocks go down and the mutual fund price goes down, they're buying more units. If it goes up, they're buying fewer units. So their average price is quite reasonable as they're saving. If they, let's suppose that they save to $10,000, just for an example.
Yeah.
Compare that with somebody who plonks in $10,000 right to begin with in any investment. If the investment goes up, that person who used the full $10,000 as their investment capital is laughing all the way to the bank. If it goes down, that person is hurting badly. With somebody dollar cost averaging, it really doesn't matter. Goes up, they're not making as much money because they're not fully invested at that time, but they are making some. Goes down, they're buying more cheaply. So when it goes back up again, they'll make even more money. So then that's dollar cost averaging. That is an advantage to younger people. You can do it in a sort of a way with our system, but it's more difficult. But it's easy with mutual funds. And as you know, Heather, our minimum investment is $10,000. And a lot of people don't have that yet. Mutual funds are a good place for them.
So what I'm hearing is your best advice to somebody who has under 10,000 is invest in mutual funds where you're getting, we can't guarantee anything, ours or theirs, but let's say for arbitrarily argument's sake, 6 to 8%, grow slowly but grow. And then once you've hit 10,000 or more and you're able to join us, our recommendation would be to do so so therefore you're in the 30% plus return zone.
Well, our selfish recommendation would be to do so. I would say once you have
selfish and or win-win, I would call it. I mean, I wouldn't want to stay at 6 or 8% all my life.
No, some people just are comfortable doing that, and that's fine. But there are other systems out there. I don't know that there are any as good as ours in terms of the return at this stage. But there will be more in the future. And it's the person's choice what they do with the money, but I wouldn't leave it in a mutual fund. That's my personal recommendation.
Yeah. Great. I think it's very clear. As always, it's really up to the individual investors to make their choices. Some people who are watching and listening are with us already in the StockExec family of investors. All others are considering. What we would say is it doesn't have to be an either or. It can be a both and. To have your mutual funds and or brokerage firm that you're working with and to open up a gratis discount brokerage account and access the advice of StockExec with, the first week or so, it might be maximum an hour, no learning necessary. And then after that, about 10 minutes a week to maintain it. That's a pretty good 3 times the return for a fraction of a time in terms of what you're needing to invest in. So
we're as close as you can get to the relaxed ability to earn money, as close as we can get to a mutual fund. It's simple, it's straightforward.
And yet much higher, as you say, on the timing and therefore the return. So any final thoughts on this one, or do you feel like it's a wrap, Sydney?
I think it's a wrap. I think I've explained as much as I can about mutual funds, and we'll leave it at that.
Well, we appreciate your 62 years of experience within the stock world, definitely having been a broker, having worked within the institutions, having worked with all of these instruments, being as objective and as transparent as possible, and to see what had motivated you to build this system in the first place, knowing you could beat mutual funds.
I used to represent some funds when I was a broker, and I'm sorry now that I did. I regret it.
Wow. Got it. Well, let us have no regrets living. If you're watching this live, stay on. There'll be Q&A in the chat box. You'll be asking your questions, and Sydney will be giving you as direct and specific and actionable answers as possible. If you're watching the recording of this, be in touch. Listening or watching anything doesn't change the dollars in your pocket or your bank account. Action does. Take the next step and go to stockexec.com/schedule to get a live demo of how the system can work for you, and or calling our 888 number 992-4558. So it's been our pleasure to be with you, and stay on if you're live and take action either way.
Schedule a live demo at stockexec.com/schedule or call 1-888-992-4558.